This is MacroVoices with hedge fund manager Erik Townsend, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Erik Townsend and Patrick Ceresna.
MacroVoices episode 220 was recorded on May 21st, 2020. I'm Erik Townsend. This episode of MacroVoices is dedicated to healthcare workers all over the world, the true heroes of the COVID-19 pandemic crisis, and is brought to you by TopTradersUnplugged.com, a podcast dedicated to quant and rules-based investing, helping investors overcome behavioral biases. Daniel Lacalle returns as this week's feature interview guest. We'll discuss the secular transition from deflation to inflation, hard assets generally, precious metals, the stock market outlook, and much more. Then be sure to stay tuned for our post-game segment after the feature interview, when Patrick and I will take another deep dive into the crude oil market, discussing both the bull and bear cases for crude oil looking forward.
And I'm Patrick Ceresna. Now, Erik, let's jump into that S&P 500. It's just resilient. It's not really ripping higher, but it doesn't want to go lower either. And we're just chopping in here. What's your take on how this all plays out?
Well, Patrick, I got my third chance to short this market above 2930, the 61.8% Fibonacci retracement of the big move down, and I passed on it for a third time. Probably the main reason is, I look at the market rallying for the silliest of reasons. In this case, what do we have? We had Moderna, a company which, by the way, insiders, including the CEO, were selling stock hand over fist as it was being bid up during this little event that happened this week. They come out, now they've done a clinical trial. How the heck they got to phase one of a clinical trial on humans without having to test animals first is a mystery to me. But they somehow managed to do a phase one clinical trial. They've got 45 patients in 3 groups at different dosage levels. And that means there's 15 people in each dosage level group. And they released only the results for 2 people per group. Well, why not for all 15? Isn't that the slightest bit suspicious? I mean, while at the same time, the CEO is selling stock hand over fist. So, this is not like we've got an incredible breakthrough and, oh my gosh, now there's a vaccine that solves everything. This is if you release extremely and suspiciously limited clinical results from a trial in a way that doesn't seem to make sense, it sounds pretty good to those who don't look at it critically. And that caused the market to jump, a great big jump up. Everybody's jumping for joy, and the market's trading higher. What happens, Patrick, when we actually get some real good news? I mean, there's got to be some good news in this story at some point. We're probably going to make real progress toward a vaccine at some point. So I just have the feeling that this market knows no limits to how much central bank largesse can continue to keep it pumped up. And I think as soon as we get some real good news, which I don't think the Moderna thing really qualified, we're probably going to see another move higher. I still think it doesn't make sense. I think that if we had normal economics, would be much lower. But, we live in this crazy world of central banks dominating market flows.
All right, well, let's move on to the dollar index. And the dollar had a reversal off the 100 handle, now down at 99.33 at the time when we're recording, largely driven by a big move in the euro. All we're doing is chopping around in this range. Is that all we should expect more of at this stage?
Yeah, I mean, until we see either a breakdown below 99 or above 101, there's nothing to say other than we're trading sideways in a consolidation range. And even if we did see a close below 99, I wouldn't really get concerned until, let's say, a daily close below 94.5. It's interesting to me that the move lower on the dollar, as well as the move lower on gold this week, seem to be connected to the hopium associated with this vaccine. So it does seem that the dollar is catching a safety bid because of the coronavirus crisis. And if we get a resolution, not just a little bit of false hope, which is what I think this news this week was, but if we get some real significant news, maybe that's going to be the catalyst for the dollar and gold as safety trade assets to have a more significant correction to the downside. So the way I looked at the action this week was just to kind of make that mental note. Okay, when we get some bona fide good news in the coronavirus crisis, maybe we should look for a bigger downside correction at that point. But I still think the most likely longer-term resolution is going to be to the upside.
All right, let's move on to crude oil because crude has just been one direction higher off of that low. It seems like it's almost overextended now to the upside. How do you think this all plays out?
Well, as we discussed off the air, Patrick, I could go on for longer than you want to listen to me on the market wrap. So let's do the executive summary now, and we'll dedicate most of the post-game segment to going deeper. The big thing that we were watching is the June contract expiry. That basically went off without a hitch, without any downside fireworks. We did not see a repeat of that May event that took us all the way down to negative prices and so forth. In fact, we even got strong backwardation, almost $1 of backwardation on the last couple of days of trading. Probably that's because people were taking excess precautions to make sure that we didn't have a repeat of last month, and it's kind of like everybody's on the other side of the boat and balances things out. Normally, you wouldn't expect to see a backwardation occur unless we had a shortage of oil. I think the reason it happened this month was just because of overcompensation of people wanting to make sure we did not have a repeat of last month. In any event, the market is sending us a very strong message that the storage crisis is over and the price recovery has begun. A lot of sentiment building. A lot of people thinking that it can only be upside from here. I think it's a little bit more nuanced than that, so let's save the rest of that discussion for the post-game segment. Inventory, crude oil drawing down 5 million barrels nationally, but that is against a build on the Strategic Petroleum Reserve of 1.9 million barrels. So net of the SPR build, it was only a 3.1 million barrel drawdown, but still a drawdown on inventory after weeks and weeks and weeks of massive builds. Cushing, Oklahoma, the ever-important delivery location for the West Texas Intermediate crude oil futures contract, drawing down a massive 5.6 million barrels, taking Cushing out of that yellow zone where it was really close to filling up. Gasoline building 2.8 million barrels, distillates building 3.8 million barrels. U.S. production ticking down another 100,000 barrels to an EIA reported figure of 11.5 million barrels per day. I suspect that number is still high. I think the real number is lower because the only way that we got out of this storage crisis was a whole lot of shut-ins and a whole lot of U.S. production coming offline. So I suspect that this EIA estimate of 11.5 million barrels is artificially high. We'll save the rest for the post-game segment after the feature interview.
All right, well, let's move on to gold because even up till yesterday, it looked like gold was just winding up along the highs for a breakout. And today it takes a step back. We're slowly backing up towards 1,700 here, right back into the center of that trade range for the last 2 months. What's your take on what's going on here in the bullion market?
Well, Patrick, it seems like the catalyst that started this downside correction was the good news or the perception of good news about a vaccine for the virus. So I think part of what's going on is everybody's preoccupation with the pandemic crisis as a major world upsetting event that was helping to support precious metals prices. Some of that premium is coming out of the market. But, we're still holding at a level as of today. Yeah, it's back down to 1724 as I look at the tape now. We've still got quite a ways before we get back down to 1,700. We got almost up to a new high a few days ago. So, this tape still looks reasonably strong to me. I am still hoping for a major downside correction. I couldn't be more bullish in the long term about gold, and I'd love to see a technical correction and the opportunity to buy some more at a lower price. So far, I've been disappointed. I'll keep my fingers crossed for lower numbers.
All right, let's touch on the 10-year Treasury yield because on Monday we had a big pop, obviously, when that big news and that drove a surge in the stock markets. But ever since then, the yield's been backing off. We're back under spot 7.0. And right now we're trading around spot 6.8 on the yield. And we're still stuck in that range. Everything seems to be range bound. I mean, is anything changed for you in terms of the 10-year Treasury yield?
Well, what this trading action has done is it's just strengthened my conviction about not having any conviction. And what I mean by that is I felt like, look, I don't want to be trading the 10-year Treasury here. I really don't have any strong conviction about which way it's headed. And what the recent news action has shown me is that, little bits of, frankly, what should have been insignificant news are really causing major changes of direction in this market. Same thing as I'm seeing in the stock market. I don't know what the next piece of news is, so I don't want to be trading it. I'm focused much more on the longer-term picture, Patrick, which is, okay, we're below 1%. Are we bottoming here because zero really is a boundary, or are we headed toward negative interest rates? And needless to say, I'll be asking Daniel Lacalle that question in today's interview.
Well, this week's feature interview guest is Daniel Lacalle. So why did we invite Daniel back on the show this week as a guest?
Well, as our regular listeners already know, I'm very much on a kick to get as many of the smart macro thinkers as we can onto the show so I can ask them all the same basic question, which is, okay, guys, we've been in a secular deflationary environment for a decade now. How do we get from here back into a secular inflation or stagflation environment? First of all, is that really what's happening? I think it is, but I want to get our guest's view on that. And if so, okay, what does the transition path look like? How do we get from here to there, and how long is it going to take? So that's really what's been on my mind as the major macro question I want to get to the bottom of. Can't think of a better guy than Daniel Lacalle to bring back on. He's a big picture macro thinker. He sees not just what's happening in the market today or what the trade is next week, but he's the kind of guy who thinks about the big picture and where the market's headed. So, and frankly, it's also a bit overdue. We haven't had him on the show in quite a while. So I'm really looking forward to this one, Patrick.
This episode of MacroVoices was made possible by TopTradersUnplugged.com. In recent weeks, we've been reminded of the fragility of world financial markets and how quickly sentiment can shift from risk on to risk off. Once again, the mantra of buy the dip and the determination of central banks will be put to the test. But as Chris Cole recently told us, the best approach to investing in the long run is very different from what's worked best in recent decades. To help MacroVoices listeners navigate an uncertain future, Niels Kastrup-Larsen, host of the Top Traders Unplugged podcast, has created a guide to the best investment books of all time. You can get a free copy at toptradersunplugged.com/macro guide. And be sure to listen to my full-length interview with Niels Kastrup-Larsen on trend following. The download link is in your Research Roundup email. Check out toptradersunplugged.com today. You'll be glad you did.
Erik's interview with Daniel Lacalle is coming up as Macro Voices continues right here at macrovoices.com.
And now, with this week's special guest, here's hedge fund manager Erik Townsend.
Joining me now is Daniel Lacalle, chief economist at Treasury and author of the new book, Freedom or Equality. Daniel has prepared a chart book to accompany today's interview. You'll find the download link in your Research Roundup email. If you don't have a Research Roundup email, just go to our homepage at macrovoices.com. Look for the red button that says Looking for the Downloads. Daniel, the question that's on everybody's mind, okay, coronavirus crisis, seems like at least the worst of the first wave is behind us now. So what does that mean for financial markets? Can we expect the V-shaped recovery that a lot of people are hoping for, or is it more likely to be U-shaped or L-shaped, or what do we expect?
Thank you very much, Erik, and thanks for having me. I think that what we are seeing right now in financial markets is the stage of what I call central bank hope. I think that the idea that we have seen the worst of the coronavirus crisis and that we have embedded in our macro and earnings assumptions lost 2020 is driving markets to think of a bottom and expect that the combination of very aggressive monetary policy plus very strong stimulus packages from governments is going to drive to a very rapid level of growth in 2021. My concern is that those two, both the central bank action and government stimuli, are likely to generate more stagnation rather than a strong and healthy recovery. Even if we look, for example, at consensus estimates for 2021, we still see that in the Eurozone, in the United States, in most of the developed economies, consensus estimates have gone slightly more bullish about the 2021, but very skewed to the latter part of the year. So we're moving, in terms of estimates, we're moving the improvement to the second quarter of 2021 now from the previous idea of growth and rapid recovery in the third and fourth quarter of 2020. I also think that the idea from governments that shutting down the economy for a couple of months would have no relevant impact long term on economic growth is out of the picture. Therefore, I believe it is going to be more of a U-shaped recovery, slow, very indebted, with very high levels of unemployment, still very difficult to recover the level of unemployment when the services sector has been hit so badly, but also very difficult to recover the level of consumption that we had in 2019 when consumers have had such a tremendous shock that even if you have not lost your job and you have not lost your salary, it is very unlikely that you're going to get out of this crisis spending in the same way that we used to do before the crisis. As such, I think that we need to be very prudent, because if anything, if we have learned anything from this crisis, is that what we have fundamentally been, even the ones that have been bearish, is too bullish.
Daniel, as you see this recovery that at least until a week or two ago just seemed like we were charging back, we hit what was just about a 61.8% retracement of the big move down. Was that, in your estimation, likely to have been the top of the bear market rally? Or could it be that we're going to, go up and test new all-time highs again before the market realizes that hey, central banks can't solve all problems with printed money?
In my opinion, that generated a top of a bear market rally, fundamentally because it was driven by the sectors that are more likely to be incentivized or perpetuated by the central bank action, by very low rates and high liquidity. Interestingly enough, this bear market rally has seen the opposite of what we saw in the bull market, which was we saw the growth stocks go higher and value stocks underperform. This has been almost the opposite. It starts to tell me that it's more about investors looking to position themselves in a way in which they can prudently look for some level of hope without being happy about the likelihood of rapid recovery. So I think that, we could see another leg down once we have discounted the majority of the stimulus, both fiscally and monetary, but also once we start to see things that are still yet to happen, like competitive devaluations in the case of emerging economies. And another important thing that I think is likely to come out of this crisis, which is an increase in protectionism and probably, I wouldn't say the same as a trade war, but certainly more protectionist measures.
I was interested to see that Stan Druckenmiller commented at a presentation, or I guess it was an online webinar for the New York Economic Club, saying that this coronavirus crisis just might be the event that finally pops the credit bubble that has been driven by central banks. And I was frustrated that they didn't really ask him to elaborate on why he thought that this event might have that outcome. Do you think that that's potentially in play? Are we maybe at the point where central bank largesse has gone as far as it can go and we're going to have a kind of realization that it can't go on forever?
I would not agree with that assessment. I think that unfortunately, what we are seeing from the Federal Reserve, the European Central Bank, the Bank of England, is actually that they're exactly following the path of the Bank of Japan. And if that tells us anything, is that it leads to stagnation and very high debt, but certainly it can last for a very long time. Think about it from a monetary perspective globally. What the Fed in particular, but also the European Central Bank is doing, those currencies that can be deemed at least to a certain extent as world reserve currencies, what they're actually doing is sucking up the savings of the rest of the world. That can go on for a very, very long time, as long as the weakness of the emerging market currencies remains, and also as long as there is a certain level of I wouldn't say growth, but at least some level of nominal growth. So that's why I think that the recovery is likely to be extremely indebted, because central banks can continue to disguise risk the way that they have been doing. They might not be able to keep spreads where they left them in 2019. And I'm thinking particularly about some countries in the Eurozone. It's very difficult for the ECB to continue to leave the spreads between Italy and Germany as tight as they were last year. But it looks to me like what central banks are doing is to incentivize the Japanese solution, which is to zombify the economy, leave things as indebted as possible, and almost bail out the unproductive at any cost.
Well, I agree with you that all indications seem to be that central banks will continue to bail out everybody with as much printed money as necessary. And I agree with you that eventually leads to probably a deep and perhaps even intractable condition of financial stagnation. Does this create the backdrop to get us out of secular deflation and into secular inflation, particularly if we see programs that are more oriented toward delivering money into the real economy, say universal basic income and other kinds of things that give money to Main Street as opposed to Wall Street?
The risk of what central banks are doing, in my opinion, is that it starts with a deflationary spiral. That deflationary spiral comes fundamentally from the fact that the productive capacity has not disappeared, and what the stimulus is incentivizing goes directly to the sectors that already had overcapacity. So those sectors will try to export their way out of the problem at the beginning of the recovery. That is deflationary. We are seeing it, for example, in China, where industrial production is coming back quickly without really having the customer base open. That obviously will probably generate a deflationary spiral at the very beginning. Now, what I'm concerned is the point that you were making, is that as governments continue to push for inflationary measures, they actually do achieve a level of inflation once the economy starts opening up, because on one side, some supply chains have been not permanently, but at least long-term damaged. And on the other hand, you have the debasement of the purchasing power of the currency through all those programs that you were mentioning. And the risk of stagflation starts to come up. That is the real problem to me, because central banks and governments, to a certain extent, have a rule book of how to address deflation and how to address inflation. But stagflation is very, very challenging for them, because on one side, they will continue to try to push for incentives to a demand that doesn't come, because because real salaries are not going up, because the productive capacity remains in excess, overcapacity in some sectors. All of those factors, plus the fact that a lot of that money creation goes directly to financing current spending, which is also deflationary. So money velocity comes down. And so you have a risk of overshooting on the disinflationary effects in the beginning that is then reacted with a higher level of stimulus from governments directed particularly to finance the real economy to a certain extent. And then what you create is stagflation.
Let's go a little bit deeper on this question of Japanification of, I think, not just the U.S., but really the entire Western economy. From what you've described, and I very much agree with you, Japan provides the reference case or the roadmap for what we might expect. Now, a lot of people have said Japan is kind of unique in the sense that although they do have an extremely high debt-to-GDP ratio, they also have a much higher percentage of their national debt which is owned domestically by Japanese. And there's also a cultural difference, which is, there's just so much of a homogeneous society in Japan. If the government tells the Japanese people it's their patriotic duty to buy Japanese bonds, they're going to do it. Whereas if you look at something like U.S. Treasuries, they're not held mostly by U.S. citizens, and I don't think U.S. citizens would feel the same obligation just because the government said so to favor an asset if its creditworthiness started to come under question. So how far can we take the Western world's indebtedness, the sovereign indebtedness situation? How much farther can it go before it really starts to blow up?
Obviously, there are numerous differences with Japan as a culture and as an economy itself. But let's focus on the things that are similar. The first one is that the massive level of indebtedness of Japan is a way of absorbing the also very high level of savings of the Japanese corporates and citizens in foreign currency. If you think about it from the US perspective in particular, it is not dissimilar to what the US does by increasing dramatically its deficit and increasing dramatically its debt, and therefore that is used as a reserve by the economies that are increasingly dollarized. No? So how long can it happen? Only until the United States decides to take measures that stop that process, which would be to take measures to stop being the world reserve currency. We don't know when that happens, but we know that there is a point in which, and we saw it, for example, in the repo market, there is a point in which something that you consider as a reserve, as a saver, stops being a reserve for you because you hold too much of it. So that's a very big risk, because the government is going to test the limits this year with a deficit that might balloon to $4 trillion. No? And it's very, very important, therefore, that the absolutely realistic situation of what is happening right now, which is that there is a huge shortage of dollars globally, doesn't come and bite you in the sense that emerging economies, other developed economies, stop seeing the treasuries as a reserve asset. It's a very thin line, and it's not something that the government dictates. The risk is important, and it comes back to your point of the cultural differences. It's not the same to say to citizens you don't basically say it either. They don't have many other options because the pension funds are controlled by the same corporations that are close to the government. But in the case of Japan, you basically feel some sort of national duty to hold sovereign bonds. That is not necessarily the case in the United States. It's certainly not necessarily have to be the case for example, central banks in other countries. And I think that that's why it is so important that the United States takes very, 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 very aggressive measures as soon as the economy opens up to reconduct the deficit, because we are approaching levels in which what you said before, which is important, is that how long can central banks maintain yields so low? It starts to be counterproductive, and the diminishing returns of monetary policy accelerate, but on a negative turn.
Daniel, let's talk about how a loss of U.S. dollar reserve currency would occur or could occur. I was very interested, if I heard you correctly, you said if the United States government took action. It sounded like you were implying that it would be the desire of the U.S. government to forfeit their reserve currency status because of problems created by having that status. The other view would be they want to keep that status, but other countries, particularly China and Russia, have expressed frustration with the U.S. having that status and would try to find ways to create alternatives. So how would you see this going down? What are the possibilities for how the global financial system might evolve to a point where the U.S. dollar is no longer the global reserve currency?
Right now, it is very difficult for a simple reason, is that most fiat currencies globally and their central banks are behaving exactly as recklessly or even more recklessly in terms of monetary policy than the Federal Reserve, but without the investor security, the legal security, the institutions, and the respect of private property that the United States has. So in a certain way, there is also a perverse situation by which the US dollar retains its reserve status fundamentally because everybody else is behaving even more insanely. You see what I mean? But that can change. And we never know, obviously, if we knew how and when, it would be a great trade. However, what I think is that if some calls that are quite recurrent in the United States about this concept of weaponizing the dollar, of devaluing the dollar for no reason, going aggressively to finance MMT style direct government spending and entitlement, etc., then you go very, very quickly from a very rich country with huge resources and huge attraction of capital to the opposite. It's basically you go from Switzerland to Argentina very quickly. And this is the risk that the United States has in front of it, is that you have too many voices in the political world thinking that everything would be great by baking the cake and eat it, as they say in the UK, which is on one side we want a weak dollar and at the same time we want it to remain the world reserve currency. Well, guess what? You cannot have both. If you have a strong economy, you will have a strong dollar. If you want the dollar to remain the world reserve currency, you cannot expect to dilute the massive imbalances of the US economy through the debasing of the purchasing power of the currency. And if I was anybody close at all to any member of parliament or the Senate or the president, I would say the last thing that you would suggest right now would be to destroy the purchasing power of the US dollar relative to the rest of emerging and developed economies, because the alleged benefits that some monetarists tell you that you would achieve, i.e., reducing the debt in real terms, i.e., getting all of the benefits of higher inflation that only governments see, would be more than offset by the displacement of capital, by the misallocation of that same capital, and by the increase in poverty and loss of attractiveness of the nation. You cannot do that.
Daniel, the way a lot of people have been framing this question of reserve currency is they think, okay, before the world wars, we had the British pound sterling as the world's global reserve currency. Then the U.S. dollar took over, and the question becomes, okay, what would the next thing be to take over and replace the dollar as the global reserve currency? And of course, for the immediate future, the answer is there is no viable alternative right now. But I wonder, in the days of the pound sterling, we didn't have a globally interconnected financial system where you can do big Forex transactions at the click of the mouse in milliseconds. So I wonder if there's really a need to have a single global reserve currency, or if we might get to a new paradigm where central banks simply diversify their reserve holdings. So instead of being primarily dollar denominated, they've got some dollars, they've got some euros, they've got some gold, they've got some other assets. Is it practical to envision a world where the U.S. dollar never gets replaced, but instead its prominence is simply demoted in the global financial system?
That is a great question, and I think that the answer is ultimately what is frustrating for central banks, for governments, and for governments and for supranational entities is that they have been trying to do precisely what you have mentioned, and they've not been able to achieve it. And the reason why is because being the world reserve currency is not something that one government, one central bank, or a group of them decide. It's actually precisely because of the reason that you just mentioned, which is that we have a global, interconnected, extremely complex financial world that decides every day where does capital go and where does it feel safer, is that we almost have a democratic process on a daily basis of what we collectively believe is the safest asset out there, even with the intervention of central banks and the intervention of governments. So even if tomorrow, imagine for a second that the IMF and the World Bank, all entities, supranational entities get together, even with the adherence of the United States, and they decide to implement a global reserve currency held by the IMF, the harsh reality of it is that it would probably not succeed if we collectively do not accept it. Why was the euro a relative success? The reason why the euro was a relative success was because of the evident failure of the lira, the peseta, the drachma, etc., etc. You see, the reason why citizens in Spain, in Italy, or in Portugal, and even Greece, with so many challenges, continue to prefer the euro than to any other alternative is because they're not amnesiac and they're not stupid. Is that they know that if they had a local domestic currency managed by the local government and domestic central bank, what they would certainly have was constant debasement of the currency and massive competitive devaluations that would destroy the purchasing power of salaries and savings. The reason why the euro works is only because people collectively have preferred to have a currency that is more akin to the similar to the Deutschmark rather than similar to the peseta or the lira. That is exactly the same with currencies and reserve assets today. Central banks, I'm sure that the PBOC, the Russian central bank, many central banks globally would probably prefer to diversify their asset base and to have a little bit more gold than dollars, for example. That's absolutely fine. The problem is to add, for example, Euro, UK, or Brazilian reserves to the asset base. That doesn't work the same way. But it does not work the same way, not because they would not want to, but because of our collective decision every day. So the interesting factor here is that despite all of the challenges and all of the excesses that we see in the United States and with the Federal Reserve, we collectively see that any other alternative would be worse. In the case of China, the yuan, because it has massive capital controls, huge challenges of what is the real valuation, etc., numerous things. In the case of the euro, because it's barely only used among the Eurozone economies, so it's a very localized currency that actually does not work very well as a reserve asset. All those things are things that are not decided by governments, are things that are decided by ourselves every day as savers. I'm sure that the Brazilian central bank today would be extremely happy to tell their citizens that they need to save in Brazilian reals. The Argentine government would be extremely happy to impose their citizens to save in Argentine pesos. The reason why they don't do it is because they know that their currency will be debased by central bank policy. So monetary policy is not a game of who wins, it's a game of who loses first. And as such, the excesses of the Federal Reserve pale in comparison with the excesses of other currencies. So can that change? Yes, it can. It can if the United States starts to believe too much on the ability to do whatever it wants with the currency without any risk. I think that one of the great things, if there's one good thing that I have to say about the Federal Reserve, is that every member that I've met in my life always pays attention to the real demand of dollars that is out there. And they always, and when they talk about unlimited and massive quantitative easing, etc., it is not true. They are talking about increasing the money supply always a little bit less than the real demand that is out there. If you think about other central banks, they completely ignore real demand of their local currency, which leads to the lack of confidence in that same currency from domestic savers and international investors, and with it, interestingly enough, a higher dependence on the dollar. That's the reason why China, being so strong, needs to have capital controls, because if they had an open market, the flight of capital would be so severe that it would destroy the economy in very little time.
Well, Daniel, the theme that you and I agree on, and frankly that almost all of the other expert guests that I agree on in these interviews, is that monetary debasement, a debasement of fiat currency, dilution by printing more dollars and more euros and so forth in order to contend with the world's problems, is the theme, and it's going to continue to be the theme going forward for probably several years to come. Now, a lot of people are saying, okay, given these circumstances, for investors, it can mean only one thing. You cannot go wrong with gold. But a few voices are saying, wait a minute, it's not quite that simple. As you said just a minute ago, central banks have been accumulating gold, and they may be forced to start selling gold to raise cash in order to deal with this coronavirus crisis, and this could actually be a setup for a washout in gold, which is going to catch everybody by surprise. Which of those possibilities is more likely, and how likely or unlikely are both of them?
I think that the reason why it is not that likely that we see a massive sell-off of gold from central banks is that, unlike in previous crises, particularly not the 2008, but 2001, 93, 92, those crises, central banks are holding on to their reserves as much as they can. In a normal crisis, the way that we have seen it today, we would be seeing the central banks of Brazil, Mexico, India, you name it, selling dollars like there's no tomorrow in order to support their currency. They're actually not doing that anymore. What most central banks are doing is trying to hold on to their reserves as much as they can, because they know that once you get into a situation in which the domestic investor stops believing that the reserve base is in some form protecting the purchasing power of the currency, then it's Venezuela. So there is a risk that some countries, as they did, for example, in the crisis previous to 2008, decide to sell their gold reserves. But those countries that do are going to be a few, and might, as by the way, as it was in that period, might be as actually an opportunity, because the level of buying of gold reserves of just China and Russia alone offsets the sell down of some of those other central banks. And supply demand actually works. So there could be a blip, absolutely there could be, but I don't think that you could see the level of destruction of reserves that central banks committed in the past. If there's anything that central banks have learned from past crises, is that it precisely in moments like the ones that we are living, holding on to reserves is a much better policy than trying to defend the currency at any cost. And in terms of coming back to the point of getting some cash, because it's not even a question of holding on to reserves, is that you need the cash in order to pay for liabilities. it is only a question of reopening the economy. One of the crucial points of this crisis that we sometimes tend to forget is that the productive capacity and that the fabric of the economy has not been destroyed. It's just shut down. So as we are seeing, for example, these days with oil that is coming back up a little bit and things like this, then it's just a question of reopening the economy, that how quickly some of those reserves come back to central banks. So I don't see that. I understand the risk. It is not small, but I don't see it as negative as, for example, in 2001.
Well, if we're going to see all of the central banks around the world not defend their currencies, allow them to be debased, that seems to really make the argument for, you can't go wrong just backing the leverage truck up and buying all the gold you can. Or is there perhaps a hidden reason why you can go wrong? What would you say for people who are tempted to really overweight gold based on the macro events that we're witnessing?
Well, I think that one thing is to have a certain amount of gold in your portfolio. It's a good decorrelated asset, central bank buy-in, emerging market demand, all of those things, supply demand picture, the fundamentals make sense. But just if you want to go aggressively overweight, massively overweight gold, you probably need to start thinking of different scenarios to the ones that we have pictured in the past minutes. You need to really start thinking of a collapse of such a level that even holding gold itself would not help you, because what you would be holding is a financial instrument attached to the price of gold. So we must remember that many of us, when we're buying gold, we're buying ETFs or we're buying instruments that are attached to the price of gold. We're not buying bullions, we're not buying gold coins. So I think that you would start to think of a different scenario than stagnation, stagflation, crisis followed by weak growth. You would need to think, in my opinion, of a complete collapse of the monetary system. And a complete collapse of the full monetary system is very difficult when all of the nations of the world are playing the same game. It's very difficult to see the end of the football league when everybody is in the football league. You can see it being less attractive, you can see it being less of an entertainment, but it's going to continue. The only way in which you would see the collapse of the monetary system as we're seeing it is if any of the possible contenders of the US dollar and the euro was actually pursuing a sound monetary policy, but they're not. That's the problem. You see what I mean? That's why I come back to the point of monetary policy is not a game of who wins, it's a game of who loses first, and of who becomes, therefore, the world's tallest small person. That is the challenge that I think is in order to get to the point of only having gold in your portfolio, you would need to start to think of a situation that we're very far away from. I prefer to see things that are a little bit more tangible. The reason why I like gold now is for all those reasons that I mentioned before, but that doesn't make it necessary to make it the only thing that you own in the portfolio.
Daniel, I want to clarify what you said, because it seems to me, first of all, I agree with you that the only scenario where you'd ever want to consider, nothing but gold in your portfolio would be if you truly believed that the entire global financial system was going to collapse and that gold would be the only thing that had any value. But that's not the scenario I'm even thinking about. I suppose that's plausible. Through the recklessness that we see, it could certainly happen. But I don't want to bet on that happening. It seems to me, though, that what is a nearly certain bet is that for several years to come, major governments around the world will continue to debase fiat money, dilute its value, trying to get inflation. Someday they'll succeed and they'll get inflation, and I won't be surprised if it quickly turns into runaway inflation. Given that prognostication, it seems to me like the only, assets that really make sense are either gold to some extent real estate and other hard assets. And, if you're of that religion, you can go down the cryptocurrency path. I don't personally feel that cryptocurrencies, which are designed to upset and annoy governments, which is the way the first generation of them works, are really going to have a long-term future. But, I could be wrong about that. It seems to me, though, that what you've got to do is come up with a trade which is the anti-debasement of fiat currency, because that's the one thing that you and I and just about all the other smart people I talk to seem to agree on. If that's not entirely a gold play, what play is it?
Well, you cannot. Well, let me start from what the point that I'm trying to make is that you cannot debase all currencies. You can debase the majority of currencies. That's what we're seeing right now. You can debase the dollar a little bit while the rest collapse. Those things can happen. But a complete debasing of all of the currencies, being it that it is, it's a two-way. So you cannot have two things devaluing at the same time. So when everybody tries to do the same thing, that is the reason why they haven't been able to generate inflation. The reason why they haven't been able to generate, not inflation, the level of inflation that they would like to have, is because everybody's doing the same thing. So ultimately, the only thing that inflates aggressively is financial assets. So in that scenario, you need to have gold, but you need to have the other part of in equities or in bonds that is most benefited from that debasement of the currency. That is why technology continues to expand in multiples. That is why the cheap sectors become cheaper and the allegedly very expensive sectors become more expensive, because you're creating this huge, huge benefit from monetary policy to the first recipients of money. And that's why I think that it would be impossible to debase all currencies at the same time. You might imagine a situation in which tomorrow the euro collapses because everybody stops having faith in the euro and the ECB is printing too much money, everything becomes a disaster, the euro collapses. Immediately, the dollar goes through the roof. Even if the Federal Reserve that moment decides to increase the balance sheet to 20 trillion, it doesn't matter. The dollar is going to go through the roof simply because the amount of leverage in the economy that is tied up to the currency system being in place, the moment that you have one major currency collapsing, the other major currency is going to rise dramatically. So, and I cannot fathom, even from a perspective of theory, I cannot imagine a situation in which the same day, at the same time, even in the same month, you would see all of those currencies, all of those reserve currencies collapsing in value. One would go through the roof. And the contender there, no, the logic dictates that would be the dollar. So to me, the trade there remains, you've got to be long some cryptocurrencies. In the case of the denationalization of money in some economies, you've got to be long gold, you've got to be long silver and palladium, in my opinion, but you have to be long equities that are massively benefited from that environment, which are, in my opinion, the closest to all that has to do with disruptive technologies.
There's a part of what you're saying that I guess I don't understand, which is why can't all fiat currencies devalue at the same time simply by virtue of their quantity being increased so that their real purchasing power decreases? So you could see, it seems to me logical to expect all fiat currencies to devalue relative to hard assets. And of course, they can't all devalue relative to other currencies, but they can devalue, I would think, compared to their purchasing power.
You're right. They can devalue, they can depreciate relative to other hard assets. I agree with you. Real estate, to a certain extent, gold, silver, palladium, that makes sense, okay? But ultimately, unless the world collectively, we are very far away from being there, has found a true alternative that is a means, that is a unit of measure, a reserve of value, and a generalized means of payment. What inevitably would happen would be that one of those currencies would go through the roof. You see what I mean?
Okay, and you think that would be the U.S. dollar despite its other problems?
Fundamentally, because what differentiates the US dollar from the euro, from the yuan, from every other, from probably except the pound, but the pound is a distant cousin of the US dollar because of the dependence of the financial sector. But every other currency has a huge flaw, which is that you don't have the same level of investor security, legal security, and absolutely unquestioned respect for private property. These things might seem strange when talking about monetary policy, yet they are absolutely critical. And why? Because on top of that, the euro on top has redenomination risk. So at some point, and we don't know why or how, Germany might decide to leave the euro, or I don't know, or France might decide to leave the euro, and you have all sorts of redenomination risks everywhere. That's one risk. In the case of China, you don't have property rights, you don't have intellectual rights, you don't have legal security and investor security rights, and on top of that, you have capital controls. So the money that you have is not even yours. It's not even available for you to do whatever you want with it. Therefore, we need to go quite a few years in front of us to see anyone or any currency out there that is a contender to a country, the United States, in which you know that if you buy a house, that house is yours. This is not, believe me, that is not so allegedly generalized as you would imagine.
Daniel, since we last had you on the program, you have a new book out called Freedom or Equality. Now, we're not used to thinking of those two things as mutually exclusive. Tell us a little bit more about the title.
The reason why I decided to write the book was because there is such a level of focus on the importance of equality at any cost that has become, in reality, the promotion of egalitarianism that is trying to convince the average citizen that there is a benefit of losing freedom, losing your personal rights and your personal freedom in order to get some form of equality, and that all of the problems that exist in the economy and in the world are inequality problems. So the reason why I call it freedom or equality is because equality is a result of prosperity. If we put equality as the main objective, we lose freedom. And that is a very, very dangerous exchange, that citizens are being told globally that in order to get some security and in order to get some level of equality, they have to give up freedom to governments that are not going to be able to give them either security or equality. As such, the idea of the book is to not only give arguments to the average reader about how to discuss about things like universal basic income, about the ideas of massive new green deals, huge government spending plans, massive taxation policies, but also to give credible solutions to improve from where we are. What we are being told every day is to take for granted all of the things that prosperity and capitalism have brought to the world, take them for granted, think that we cannot get any worse, and give in to socialist policies. And what I try to show in the book is that we can continue to develop capitalism to a more acceptable and available to everyone solution that provides the response to the social challenges, healthcare, education, etc., without going into the territory of massive interventionism that is not going to give us either the equality or the freedom that we so deserve.
Well, Daniel, I can't thank you enough for a terrific interview. Please tell our listeners, before we let you go, how they can follow your work, handles on Twitter and websites and so forth.
Yes, you can follow me on Twitter. The handle is at DLACALLE_IA. My website, www.dlacalle.com. You also can find me in my YouTube channel, And in Instagram or LinkedIn, it's very difficult not to find me if you look for me. So, and very happy to continue the dialogue.
Okay, we look forward to having you back on the show in a few months for another update. Patrick Ceresna and I will be back as MacroVoices continues right here at MacroVoices.com.
MacroVoices is a listener-driven program. Please email requests for specific future interview guests to requests@macrovoices.com. You can email questions for the program to mailbag@macrovoices.com, and we'll answer them on the air from time to time in our mailbag segment. We also welcome your suggestions for how we can improve the program. Now, back to your hosts, Erik Townsend and Patrick Ceresna.
Erik, it was great to have Daniel back on the show. You know, I continue to be baffled by the idea, like the stock market is in this V recovery, right? Like the bottom came in and it's just ripping higher, and everyone is associating that must somehow mean the economy will also V recover. But the economy has a much different path, and Daniel was alluding to that, about the idea that it's going to be a much more long and prolonged process. And it's really going to be interesting to see how much this disconnection between equities and the economy, how long it lasts and where it really goes. What did you take away from the interview?
Well, I agree with that, and I think that there's a really strong case here for what happens is we know this crisis is going to bring a whole lot more money printing from central banks, and that is probably going to support asset markets even if the economy doesn't recover anytime soon. And I think that's really the dynamic that we're seeing with the stock market. But Patrick, what really hit home for me in this discussion was Daniel confirms something that we've heard from all the other smartest voices that we have on MacroVoices, which is this trend toward hard assets over paper assets, that we're moving into an era of central banks just continuing to debase the value of fiat currency to the point where, for now it's propping up those paper asset markets. But someday you want to have the security of physical assets, whether it be gold, real estate, or other hard physical assets. And I think that's a really important secular trend to pay attention to. Patrick, I did a spotlight interview this week with Scott Lynn from Masterworks. Now, this is fascinating to me as we think about this whole trend around hard assets. Scott is a guy who basically figured out, hey, the smartest big boys of finance, they're all recognizing that fine art is an important asset class, actually outperforms the S&P 500 in a lot of cases, if you can afford to buy it. And so, a lot of the biggest names in finance are buying these very expensive paintings that cost several $1,000,000 and have shown a pattern of appreciating more than stocks in a lot of cases. So Scott recognizes, holy cow, this is a market that is so ripe that so many people want to be part of. Most people can't afford to be, and that also requires a lot of skill because you got to know what you're doing to buy the right kind of art. So he figures out how to securitize it by essentially offering something similar to a hedge fund structure, but a way that allows any investor to invest on a fractional ownership basis in fine artworks, which are normally, out of the price range of most investors. And it really got me to think, okay, what else has yet to be securitized? Art was an obvious pick because it requires the skill of somebody who really knows about art to buy the right art. Well, what else is there? Wine collections. Somebody on Twitter suggested classic car collections. There's probably a lot of collectibles, a lot of physical things where there's opportunities for people to do what Scott has done and offer securitized investment vehicles to make them available to more people. So it just makes me wonder if we're going to see a major trend of people doing the same thing that Scott did with Masterworks. So it was a fascinating interview. I encourage our listeners to check it out. You'll find the link in the Research Roundup email. And I would encourage our entrepreneurs in the audience to think about, as you listen to, Scott's done a fantastic job with this business. What else besides fine art that requires knowledge and skill to buy it right? Where is there opportunity for other people to securitize other hard asset classes? I think farmland, they've already done that. There's an ETF for buying farmland, which is another big hard asset favorite of some of the biggest investors. What else are the big boys investing in that little boys can't get into, and who's going to be the first to securitize them? I think it's an interesting trend.
Okay, well, let's dive into the crude oil market, starting with the recent events. You told us last week to watch the expiration of the June contract, which happened earlier this week, for final confirmation that the storage crisis is under control, at least for now. So how did that all go?
Well, basically everything went off without a hitch. There was no negative prices. There was no crashing of the June contract at the last minute. In fact, we even got to almost a full $1 of backwardation, not contango, but backwardation, the opposite of contango, on the June-July contract at one point. Now, normally that could only happen if the tanks were running dry and people were panicking that we were about to run out of oil in storage. Well, how could that possibly be happening now when we have the opposite fundamental conditions in terms of the amount of oil in storage? I think the answer is, this is a market that's knee-jerking all over the place. So what we had was a panic situation of too much oil and no place to store it. Then we had the May event, the May contract expiry that took us to minus $40 prices because people were panicking and there was no place to put the oil. And there were also, frankly, some traders that made some really dumb mistakes and got squeezed. Well, I think that probably there's some invisible hands at work here, Patrick. If you think about what is really going on, the WTI benchmark, the fact that West Texas Intermediate Crude and the CME Group's NYMEX futures contract for it are arguably the most important crude oil benchmark price in the entire industry. They were facing an existential threat. If they had another out-of-control blow-up like happened last month, I think that it probably would have been the end of WTI as a benchmark index. I think a lot of very powerful people wanted to make sure that that didn't happen no matter what, and I suspect that they had plenty of people standing by if there was a price rout to buy up a whole bunch of oil if necessary to prevent another price crash. Of course, what that means is as you go into the expiry, into the last day, those people that were setting storage aside for that reason, even if the price doesn't crash, they're still going to buy some oil in order to fill up the storage that they had set aside for it. And I think that probably is how we got into backwardation, just because there had been an excessive amount of people making sure that there was no repeat of last month. It's the only way I can possibly explain it. So what happens is production was forced lower. I think after the debacle with the May contract expiration a month ago, people freaked out, and people who were on the fence about shutting in production on their oil wells went ahead and shut in production. That happened so much that we got to a point where, at least temporarily, there's no more crunch. In fact, we're seeing drawdowns out of Cushing, Oklahoma, so that there is finally, a little bit more storage capacity available than there was just a few weeks ago. Question is whether that's going to last. Another really big question to understand, and I don't claim to have all of the answers yet. We'll probably need to get Art Berman back on the program at some point soon to talk about this. It's okay. How much of that capacity, how much of those shut-ins that have just happened in the last couple of months of U.S. production are never coming back online? There are some stripper wells, which from everything I'm reading, they were borderline economic to start with. A lot of them got shut in by filling the well casings with concrete plugs that would have to be drilled through in order to restart them. Those oil wells are never coming back online. It's not going to be economic to put them back online. On the other hand, from what I understand, some of the latest technology, the most modern technology, shale wells, it's literally a few taps on an iPhone in order to restart some submersible pumps and bring those shut-in wells back online again. So it's, in some cases at least, it's very simple to take that idled capacity and turn it back on. Well, how much of the capacity that got turned off is stuck off? And how much of it can easily be turned back on? That really is going to play a huge role in deciding what happens to this market from here. I don't know all of those answers. So let's try to see if we can get Art Berman booked to come back and talk to us a little bit about that. I think that the combination of a short squeeze on time spreads which was a very overcrowded trade to start with, plus a lot of those tanker deals that were taking a whole bunch of oil out of on-land storage, putting it into floating storage, and, of course, the shut-ins of production, reducing that oversupply. It just all led to a perfect storm of when everybody feared Cushing was going to hit the tank tops, it ended up going the other way, and now there's a big sigh of relief. The thing is, everybody is breathing this sigh of relief as if it was completely totally over and there's nothing to worry about now. I'm not completely convinced of that. There's one article that Bloomberg had saying that they're already restarting shale wells that were taken offline because of the event that happened at the expiry of the May contract. Well, if they're going to turn all this stuff back on again and we get a second wave of the coronavirus crisis, we could go through a whole second round of super contango, whole second round of storage crisis, tanks actually hitting tank tops. It could all come back. The really big question is how much of that idled capacity can easily be turned back on and how much of it falls into the category, which seems to be true of the older wells, that once you shut it in, there's a really, really big cost associated with turning it back on again. I think that's going to play a really important role, and I need to do a little more homework in order to understand exactly what the interplay is there. In any event, Patrick, we need to really understand both the bull and bear arguments so that when we do get more information and we also see how things are going, we know how to read the tea leaves and how to anticipate what's going to happen next.
Okay, let's start with the bullish argument since that's what's on a lot of people's mind right now.
Patrick, the real key to understanding this is understanding how much of the supply that's been taken offline can be easily turned back on and how much of it is going to stay offline because it will be uneconomic to turn it back on. Now, remember, some of those old stripper wells, they were borderline economic even before this crisis. A lot of those are going to be retired and never brought back online, but frankly, they didn't represent a very large overall amount of production capacity to start with. As I mentioned earlier, I'm told that the very latest technology makes it possible to just shut in and then restart some of these wells that use submersible pumps literally by a few taps on an iPhone or an iPad. I don't know that percentage breakdown. I wish that I did. But the key to understanding the bull case is if we have seen a lot of production come offline that cannot easily come back online, then you don't necessarily need a full economic recovery. You don't have to see a V-shaped economic recovery in order to get a V-shaped oil price recovery. Remember that oil prices are extremely sensitive to supply and demand. It only takes a small imbalance of supply and demand to move oil prices by a lot. So the bull argument is strongest if you think that a major second wave of coronavirus is unlikely. Now, that's not my view, but a lot of people think it's very unlikely. Even if there was a second wave, we're going to reopen the economy anyway. So, second wave or no second wave, there's going to be more demand. If that demand is now going to balance not against the old supply numbers, but the new supply numbers. If those new supply numbers have been forced much lower because a lot of production was taken offline, concrete plugs were installed in wells that would have to be drilled through, which is not going to happen, so it's going to stay offline. There's a case there for a very, very rapid V-shaped price recovery, even in the face of a stagnant economic recovery, just because so much oil was taken out of production. So that's the really strong bull argument. And, don't underestimate how quickly Cushing and remaining U.S. storage could draw down from near maximum levels to near minimum levels. It doesn't take too big of a supply-demand imbalance to radically change that situation of how storage is in Cushing. So if you look at this in isolation with all other factors remaining equal, you can easily make the argument that, holy cow, if there's a lot of supply destruction which was permanent and we get even a partial economic recovery because we are going to restart the economy with or without a second wave, we're still going to be operating the economy. boy, there could be a moonshot to the upside in prices. There really is a strong argument there. The thing is, all things are not equal. OPEC Plus is very cognizant of certain price thresholds at which it does become economic to drill new shale oil wells in the United States and to go ahead and restart even the ones that are expensive to restart. So at some point before OPEC Plus allows us to get to those price levels, they're going to start increasing their production in order to temper the pace at which oil prices recover. So we have to be cognizant of that. The main point that I want to make about the bull case, though, is it's already started. I think it's almost certain that it's going to continue at least a little bit higher. The momentum right now to the upside on oil prices is unquestionable. The question is whether it can really be sustained all the way up to a full price recovery, or if we've got, we had an overshot to the downside, clearly at minus $40 prices. Is the pendulum already swinging too far, too quickly in the other direction? And are we going to be subject to a major pullback and a reversal of sentiment if it turns out that a second virus wave kind of puts a damper on the enthusiasm that exists in the market right now?
Now, I wanted to ask you how to play the bull case in terms of market positioning, but let's first discuss the bear argument a little bit.
Well, as I just said, the bull case is already in motion. It's happening. It's already run pretty far. My sense is that the market is pricing in an expectation that there is no second wave and that a V-shaped demand recovery is going to occur. Now, I think those are dangerous assumptions, although they are plausible. I think there's a little bit too much bullish enthusiasm in this market. Everybody, I think, is getting sucked in to this. Well, the prices are so low, they just can't go wrong. In the long run, it's got to be all uphill from here. Well, that's in the long run, that will be true, but there's plenty of room for more downside volatility from here before we get to that. The question is, now that the forcing function, the thing that really pulled us way down to not just zero price but negative price, was there's a forcing function that when you start to run out of storage, there's no place to put the oil, the price just has to keep going lower until it incentivizes the creation of more storage. It seems like, for now at least, that forcing function is no longer in play. What that means is we can have a sentiment-driven rally where all it takes is people getting excited to drive the prices to almost any level. At some point, I think that's going to become overdone. But I have to critique myself because I've said a few times now that I thought it was already overdone, and boy, look, it's continued. So I'm trying to be a little more realistic and say, okay, this probably still could have a lot more room to move to the upside if the sentiment continues to be right where it is, because there's really nothing. If you look at the technical charts, we've broken through some key levels. I don't see anything on the WTI chart until $38 or so at the 100-month moving average, and that's on the continuation chart. It's 39.79 on the contract chart. So, you're somewhere between $38 and $40 before you get to the next significant technical resistance on the chart. There's lots of room to run to the upside until we get a change in sentiment. And so far, I don't see any sign of that sentiment changing. But I think at some point, if we do get a second wave of coronavirus and there's a realization that even if lockdowns are lifted, that still voluntary behavior does not bring back oil demand, because people still, if they're allowed to fly on airline flights, don't want to. That's not being priced in right now. If there is a public realization of what seems pretty clear to me, which is there's no good reason to assume that a coronavirus vaccine is a certainty. We certainly have a lot of very smart medical minds working on one. Hopefully we'll get one, but it doesn't mean it's a certainty, and it doesn't mean that it's certain to be completely effective. I think that once some of that reality hits the tape, there could be another, reversal of sentiment and maybe an overshoot to the downside again. This is a very, very volatile market. There's a lot of reason to see room for this to go either way. Right now, the trend is up, I would say, with some reckless enthusiasm. Who's to say we're not going to get another down leg with a little bit more reckless enthusiasm in the opposite direction? If we do, though, I think it's time to definitely be buying that next bottom if you didn't already buy the first bottom, or adding leverage on the next bottom, because ultimately this is going to resolve to the upside.
Now, I want to talk about how to trade the long side throughout the recovery in oil prices. And in the past, you said that ETFs such as the USO were bad choices because they suffer from the huge tracking error as a result of contango losses rolling forward their positions. So how do you, as a futures trader, approach the long side of this market?
Well, hold on, because it's important to understand that USO issue. The problem with USO was, past tense, that they used to be exposed almost entirely to the front month futures contract and just roll it all at once right before it expired. That meant that they were subject to huge tracking errors when there was super contango in the market, which is what happens when you get into a very strong demand for storage, as we had recently. Now, ironically, that super contango is basically gone from the market now. So the way that USO used to work before they changed it would actually perform quite well in the present environment that we have today, because holding the front month futures contract and rolling it just before it expires is actually what's performing best right now, because first of all, you don't have that super contango in the market, but also the super contango has just come out of the market, which means if you were exposed to that front month contract, that's where you got the biggest upside as the super contango was coming out of the market. Now, that's ironic that it used to be that way, but now USO doesn't work that way anymore. So the way USO is positioned, it's suboptimal for a different set of reasons, which is it's exposed to later contracts in order to avoid the super contango, and they're missing out on the big upside that exists in the front month contract. Now, that's ironic to be sure, but I don't think it's coincidental. In fact, I think there's a causal relationship there. One of the reasons that we got to such extreme super contango was because the USO ETF represents such a large percentage of the market that was all concentrated as a paper long in the front month that everybody knew was there, that everybody knew had to be rolled every month. And the market was basically exploiting the retail investor by creating a situation where that large tracking error would occur. The fact that USO completely changed the way that they do things and now that strategy's not working is not a coincidence. It's because they changed the way that they do things that is part of the reason that the super contango was able to come out of the market, and it's part of the reason that it's not performing now. So these exchange-traded products like USO are really not the optimal way to try to trade the futures market. I don't know why they're so popular. Getting back to how to trade this in the futures market, if you believe that super contango is gone for good, it's not coming back, we're not going to have any more storage problems, then holding and rolling the front month futures contract definitely has a lot of merit. One really big caveat, though, Patrick, is the exchange has dramatically increased the margin requirements for the front month contract specifically. So depending on how much leverage you use and how sensitive you are to margin requirements, there is kind of a case to be made for holding the second month or even the third month instead of the first month, because there's a much smaller margin requirement to be exposed to that contract. But the question that's more important is this super contango experience that we had with storage, is it really behind us? Or is it maybe more the case that what happened is that short squeeze and the restructuring of USO led to the super contango rapidly coming out of the market as something of an overshoot that went too far, and it's now going to retrace in the other direction, and some of that super contango is going to come back into the market. If you think that's what's going to happen, you don't want to be in the front month contract for all the reasons that you didn't used to want to be in USO back in the day when it was exposed to the front month contract. Now, the way professional futures traders overcome super contango, and frankly, the way a lot of them do position trading on the long side of the crude market to start with, is by using time spreads at the back of the curve. Now, I should explain, it's an expression in the industry. People say the back of the curve, meaning not the front of the curve. We're not really talking about all the way at the back of the curve, like futures that are dated 2027 and 2028. Nobody trades that stuff. When futures traders talk about the back of the curve, they mean 2 or 3 years out as opposed to the front month contract. Those time spreads on the back of the curve are a proxy for the flat price, but it's often less volatile than the flat price. And the reason is it's mostly professionals that are trading it. So whereas the front month futures contract gets ripped around by the influence of these exchange traded products like the USO and UCO and these various other ETPs, the time spreads tend to be less volatile, and they provide a more stable way of expressing a long view. Now, there's some nuance to that. You have to understand the concepts associated with term structure because there are scenarios depending on what happens with refinery outages and pipelines and so on and so forth, where you could have a disconnect between the front month price and the performance of those back of curve time spreads. But in most cases, the back of the curve time spread is an effective proxy for flat price, and it's not subject to the effects of super contango. So you get kind of a double benefit there. Usually, they're traded on the most liquid December contracts only. In other words, if you're trading 2 or 3 years out, there's no liquidity in the April of 2022 contract. Doesn't make sense to trade that. There's plenty of liquidity in the December contracts. So right now, a very popular trade, Patrick, is long the December 2020 contract and short the December 21 contract. That's a popular trade because a lot of people tend to just go to whatever the next December is. Right now, the nearest December is December of 20. Next one after that is December of 21. Okay, Z1, Z2, or dies red dies is the expression in the industry for that spread. Here's the reason I think that's a bad idea. December 20 is too close. If we get a return to super contango, that December 20 contract is going to get sucked down in that super contango event because it's too close to the front of the curve. So I don't like that Z0, Z1 or December 20 to December 21 spread, even though it does seem to be pretty popular right now. I think that long December of 21, short December of 22 is a much smarter time spread to trade as a proxy to express a long-term bullish view on oil prices. You could split the difference instead by using the June contracts, which are the second most liquid contract after the December contracts, by going long June of 20 and short June of 21. Now, that's a little bit closer to the ideal in terms of how far out on the curve it is. But the thing is, there's a lot less liquidity in those June contracts, so especially for larger traders, you really need to be in the Decembers. But there's also a hidden problem, which is, think about the fact that USO, one of the things that they did when they restructured is they moved a lot of their exposure. I guess it's actually only about 10% of their exposure, but still, they're a big piece of the market. So there's a great big position that USO holds long the June 21 contract. Well, if you're going to express your spread trade as long June 21 and short June 22, what happens when USO eventually decides to roll out of that June 21? They're probably going to pull that price down so that you're making a significant risk there of being in a contract where your long position is the same position that USO is in and that USO is going to eventually roll out of. Well, the question then becomes, when is USO going to move out of that June 21 position that they have? I can't find any intelligence on that. The USO seems to be very open about telling people ahead of time what their trading plans are. As far as this June 21 position that they now have, clearly they're not going to roll it to July 21. That doesn't make any sense. It's not liquid enough. They probably at some point are going to roll that to December of 21. So if you knew that that was their plan and you could front run it by being long the June 21 to June 22 spread now And just before USO rolls their position, you roll your position first out of M1, M2 into Z1, Z2. And then after that, USO rolls from M1 to Z1. You're going to get a bump. You're going to benefit from the fact that USO trading a contract that far into the future is probably going to move the needle on price. You'd have to know ahead of time what their intentions are. If anybody listening knows their intentions or has any insights on that, I'm very interested because I'm tempted by that. But for now, I like the Z1, Z2 spread as my favorite trade for expressing a long view. And in the interest of full disclosure, that is my current trade. I do have exposure to the long time spreads. I've actually been accumulating that through all of this crisis. I've been accumulating the long-dated time spreads on the long side. For quite a while, I had a larger short position on the near-dated time spreads, so they were hedging one another. At this point, I've covered all of my short time spreads, so my only exposure is to the long side. That's what I'm playing right now because I think for now the trend is very clearly up. At some point, I won't be surprised if this sentiment reverses. At that point, I'm not going to close my longs. I'm very much want to keep these long exposures to those long-dated time spreads. But what I will do is I'll go back to adding short time spreads at the front of the curve to hedge that downside risk because I do think that we're probably going to get another wave down before this is over.
Now, we got a lot of inquiries from retail investors asking how retail traders should get in on these trades. What do you say to our retail listeners about how to do this?
You know, I've given a lot of thought to this, and I certainly don't want to put anybody off. You know, we love all of our listeners. But look, MacroVoices is not intended, it's not designed for retail traders. As Andy, our announcer, says at the beginning of every show, MacroVoices is for professional finance, family offices, and very sophisticated private investors. And we, of course, welcome retail traders to listen to the program. It's not designed for that. And frankly, the real reason is I don't know. I'm a futures trader. I would never try to trade commodities through exchange-traded products like USO and these other ETPs. I think that's crazy. They're very flawed products that don't make much sense. It seems logical to me that you do one of two things. You either learn all about this, and it is a fairly significant learning curve to learn all about how to trade futures, including understanding the term structure of the futures market, or don't try to trade it. Now, there are proxies like buying, ETPs like XLE, which is the oil companies, trading the stock of the oil companies rather than the commodity itself. Look, I don't have any personal experience with that. I'm not an expert on that. Patrick, you, on the other hand, at Big Picture Trading, I know you do a lot of work with a much larger retail audience to try to translate some of these trades to how to, do this for retail accounts. So I guess my advice is, sign up for Big Picture Trading. If you don't want to pay for Big Picture Trading, you can watch Kramer on TV. But MacroVoices is not designed to explain how to translate stuff to retail trades because I don't know how to do that.
Okay, I got it. So for the pros, you take the long time spreads at the back of the curve, particularly focusing on that and favoring that spread between December 2021 and 22. But you hedge that with some of the short front of the curve time spreads if sentiment was to reverse. And for those of our retail audience, your answer to them is learn to trade futures and the intricacies of the term structure, or just stick with retail products and stop trying to trade commodities through these inefficient ETPs and that suffer all these large tracking errors, right? For me, I find that the correlations between many energy companies and that of oil allow a lot of retail investors to just trade it through many of those energy companies. But that we can have as another conversation in one of our future episodes. Was there anything else you wanted to add here?
Well, I just want to agree with what you just said, Patrick, which is I think that if you want to take this to looking at trading the oil companies, an ETF like XLE is a very efficient, effective way to trade a basket of oil company stocks. It's well suited to that. Whereas these ETPs that try to trade commodities without any comprehension of how the term structure works, they just seem like a dumb idea. So my strong advice to anyone is either stay away from USO and all these other commodity ETPs like DBA that have all these huge tracking errors because they're administered in a way that has no cognizance of the effects of contango and backwardation in the term structure. Trade stocks instead, something that makes sense to trade through those exchange-traded funds. Or if you are not satisfied with that and you really want to trade commodities, learn how to trade commodities. It just seems like a pretty clear choice to me. In any event, Patrick, we're going to need to leave it there for this week's show. This episode was made possible by TopTradersUnplugged.com. Remember to get the ultimate guide to the best investing books ever written at TopTradersUnplugged.com/macro guide. For information on sponsoring Macro Voices, please visit macrovoices.com/sponsor info. Listeners, be sure to register a free account at macrovoices.com. The benefit to you is you'll receive our Research Roundup email, which provides you with all of the best free content that we could find on the internet each week, including downloads associated with our guest appearances, as well as, of course, our post-game chart books. Patrick, tell them what they missed in this week's Research Roundup.
Well, this week you're going to find the transcript for today's interview, as well as a link to a chart deck provided by Daniel Lacalle. Also, there's an interesting article from Seth Levine titled Collateral, Leverage, and Volatility. You'll also find the link to Erik's interview with Scott Lynn about securitized fine art investing. And a really interesting blog article from Variant Perception about the upside inflation risks favoring the value investor. So you'll find this and so much more in this week's Research Roundup. That does it for this week's episode. We appreciate all the feedback and support we get from our listeners, and we're always looking for suggestions on how we can make the program even better. Now, for those of our listeners that write or blog about the markets and would like to share that content with our listeners, send us an email at researchroundup@macrovoices.com or tag it with the MVRR hashtag on Twitter, and we will include it in our weekly distributions. If you have not already, follow our main Twitter account at MacroVoices for all the most recent updates and releases. You can also follow Erik on Twitter at Erik S. Townsend and myself at Patrick Ceresna. On behalf of Erik Townsend and myself, thank you for listening, and we'll see you all next week.
That concludes this edition of Macro Voices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. Macro Voices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to Macro Voices on iTunes to have Macro Voices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. Macro Voices is presented for informational and entertainment purposes only. The information presented on Macro Voices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on Macro Voices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. Macro Voices, its producers, sponsors, and hosts Erik Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on Macro Voices. Macro Voices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit macrovoices.com.